Hello and welcome back to Global Value. In today's video, we're performing a fundamental stock analysis of the Progressive Corporation, ticker symbol PGR. Progressive Insurance is the main competitor to Berkshire Hathaway's Geico, which is famously one of Warren Buffett's favorite businesses of all time. Warren Buffett's investment in Geico in the early to mid 70s is probably his best performing investment long term. Warren Buffett's teacher and mentor Ben Graham also had Geico as his most successful investment throughout his investing career, even though he originally invested into it in the 1950s. Progressive, as Geico's main competitor, is a business whose quality is cut from the same cloth. Currently, Progressive is trading for $129.38 per share, and their stock price is up 36% over the last year. Over the last 5 years, Progressive has compounded at a rate of 19% annually. Over 10 years, they're compounding at a rate of 20% annually. And going back prior to the global financial crisis, over the last 18 years, Progressive has compounded at a rate of about 11% annually. Keep in mind that this compounded annual return is not including their dividends. Currently, they're paying out a very modest 0.3% dividend yield. So Progressive is about $5 below their 52-week high. They're up more than $30 from their 52-week low, and Progressive is a very large business. They have a $76 billion market cap. So for additional background about the company, Progressive underwrites private and commercial auto insurance and specialty lines. It has over 20 million personal auto policies in force, and it is the fourth largest auto insurer in the United States. Progressive markets its policies through independent insurance agencies in the US and Canada, and directly via the internet and telephone. Its premiums are split roughly equally between the agent and the direct channel. The company also offers commercial auto policies and entered homeowners insurance through an acquisition in 2015. The Progressive Corporation was founded in 1937 and is headquartered in Mayfield, Ohio. So for our fundamental analysis today, we are performing the Select 6 analysis, taking a checklist-style approach of 6 standard financial metrics to come to a holistic and beginning understanding of Progressive based off of their business fundamentals. So this analysis is still a work in progress, and it's an opportunity to learn in public. This is the first time we're using it to evaluate an insurance company, and it will continue to improve and get better over time. I would love to hear feedback in the comments below. So with that said, let's get right into today's analysis. Starting things off with metric number 1, we want their average return on capital over the last 5 years to be above 14%. So there are 2 key reasons for this. The first is that the average publicly listed business earns about a 7% return on capital, and the second is that over the long run, over the course of decades, a stock is likely to return approximately what its underlying business returns, and these underlying business returns are captured here by return on capital. So by asking for a benchmark of 14% or higher, we can potentially build in some margin of safety for ourselves based off the overall quality of the business being about twice as good as average. In the case of Progressive, they're earning well above average returns on capital in all 5 of these fiscal years. During this time, they peaked at about 32% returns on capital during 2020, when very few people were driving due to the COVID-19 pandemic lockdowns. Since then, their returns on capital have been declining. They produced 19% returns on capital in 2021. However, over their last 12 months, they've only produced about 7.5% returns on capital. Even still, averaged out over this period, Progressive is earning about 24% returns on capital, which is 3 times better than that of an average business and solidly above that 14% benchmark we're looking for. So this is a check to start things off on metric number 1. Next up for metric number 2, here we're taking a high-level overview of the growth of the business. We're looking for revenues, net income, and free cash flow growth over the last 5 years, and this metric is all or nothing in nature. Either all 3 of these are going to be up for this to be a check, or if even one of them is down, this entire metric will be an X. We'll be including their last 12 months worth of numbers in our calculations here. Over this time from 2017 to currently, Progressive's revenues are up about 80%. So major revenue growth there. Their earnings, which look like they've almost doubled from 2017 to 2021, are actually down about 50%. So they've only brought in about $800 million in net income over their last 12 months. This has been due to growth in expenses in terms of their policy benefits and their underwriting costs. However, even though their earnings are down, their free cash flows are up by about 66% over this same period. So this is important because free cash flow is really the lifeblood of any business, and a business can use its free cash flows to pay dividends, reinvest back into the business, make acquisitions, buy back shares, or pay down debt. So ultimately, a business's abilities to produce free cash flows now and until Judgment Day, discounted back by some reasonable interest rate, is ultimately what that business is going to be worth. Again, because of their earnings being down, this is going to be an X on metric number 2, although it is good to see that they had revenue and especially free cash flow growth over this same period. Next up, for metric number 3, here we're taking the perspective of an individual shareholder in the business by looking at Progressive on a per-share basis. So we're looking for earnings per share growth over the last 5 years. From fiscal 2017 to fiscal 2021, this seems like this would have been the case. However, because their earnings are down by 50% over their last 12 months, their earnings per share are also down by about that same amount. And this is because Progressive has kept their shares outstanding basically flat over this time frame. So with their shares outstanding being flat and their earnings down by about 50%, their earnings per share are down as well. So this is going to be our second X in a row here on metric number 3. For metric number 4, we're looking for something very similar. So here we're looking for free cash flow per share growth over the last 5 years. In contrast to their earnings per share, their free cash flows per share are going to be up because their free cash flows are up over this period, meaning that this is a check on metric number 4. So to recap where we stand currently, through our first 4 metrics, we're split evenly, 2 checks and 2 X's so far on Progressive. Then next up for metric number 5, here we're evaluating how the business is utilizing leverage. So we don't want to be investing in overly levered businesses because during economic downturns, it's overly levered businesses that are going to be at the greatest risk of poor outcomes. So we want their net debt, which is their total debt minus their cash and their short-term investments, to be below the amount of free cash flow that they produced over the last 5 years. Progressive ended 2021 with $4.9 billion worth of net debt. Currently, they've increased this sum and they have about $6 billion worth of net debt. However, over the last 5 years, Progressive has produced more than $30 billion worth of free cash flow, meaning that they would be able to pay off all of this debt with only 1 year's worth of free cash flow. This is a massive check here on metric number 5, as it doesn't look like the business is overly levered compared to its free cash flows really in the slightest. They're bringing in plenty of free cash flows historically, and over their last 12 months, they brought in about $6 billion worth of free cash flow as well. So it looks like their net debt is very easily supported by their free cash flows. And as a semi-regulated insurance company, there are a number of different financial standards that the company has to meet. So it would seem like they're not overextending themselves in terms of their debt position. This is a check here on metric number 5, and so far we have 3 checks and 2 X's. Then our 6th and final metric, the big metric of them all, we want their average free cash flow to their total enterprise value to give us a yield that's above 5%. If this is the case, this will potentially give us a slight risk premium to the rate of the 10-year treasury yield and potentially give us another reason to be interested in the business. So we're using their total enterprise value because it's taking into account both their market cap and their net debt position. And it'll give us a perspective of the business that's going to be more similar to as if Progressive were a private company. So right now, Progressive has about an $82 billion total enterprise value. And we learned that over the last 5 years, they produced about $30 billion worth of free cash flow, meaning that in an average year, they're producing about $6 billion worth of free cash flow. So when we take their $6 billion of their average free cash flow divided by their $82 billion total enterprise value, that gives us an average free cash flow to enterprise value yield that's above 7%. So on an average basis, this is a check on metric number 6, as it does look like there's the potential for a slight risk premium. And as mentioned in the previous metric, they've earned about $6 billion over their last 12 months worth of free cash flow, meaning that their current free cash flow to enterprise value yield is also above 7%. So both on an average and a historical basis, it does look like Progressive is potentially interesting and would likely be worth your while to dig in and learn more about, especially as they're coupling their high free cash flow yields with very strong returns on capital. Just because this is a check here on metric number 6 doesn't mean that you're going to run out and buy the business. This analysis is not financial advice, and this is one of 6 of our metrics. Even though these metrics are simple, when combined together, they can be powerful, but it still serves to help you understand whether you want to dig into the company or not. Then as a bonus, here we're looking at Progressive's dividend profile. So Progressive right now is only paying out a dividend yield of 0.3%. So that is a very modest dividend yield, and it's unlikely that their dividend payout would play much of a role at all in terms of how people are looking at the business. However, it's worth noting that over their last 5 years, they have increased their dividends. This has been somewhat sporadic, and they did offer a somewhat special dividend in 2020 because of their low claims. At the same time, Progressive has steadily increased their cash flows over this time frame, and in all 5 of these years, they've had more than enough cash flows coming in to healthily and sustainably pay out this dividend. So even though past performance is no guarantee of future performance, it does look like Progressive's dividend seems like it would be in pretty healthy shape. Everything we've discussed so far is important, but there's something missing that, in my opinion, is the main reason to look at an analysis of Progressive, which takes us on to using a discounted cash flow model to come to a potential fair value for the business. So a discounted cash flow model is just like any other model in any other discipline. Its outputs are going to be sensitive to its inputs. So here we're using their current free cash flows per share and projecting those out into the future based off of their historical abilities to grow their free cash flows over the last 20 years. So based off these historical assumptions, which you need to do your own homework on to determine whether or not these are going to be potentially accurate and applicable to give us a baseline projected estimate for the business going forward, then using a growth stage for the business over the next 10 years where they grow their free cash flows at a rate of about 10% annually, and following that with a terminal stage over the 10 years out after that, where that free cash flow growth falls in half and they only grow their free cash flows at a rate of 5% annually, then from today's valuations, it looks like you could reasonably expect about a 14% rate of return going forward from Progressive. Using these same historical growth assumptions, if you are only seeking a 10% rate of return going forward from Progressive, it looks like a fair value for the business is around $179 per share. Please keep in mind that these are based off of these inputs, and so you have to do your own homework, and that this type of analysis is not financial advice, it's not a buy or sell recommendation of any security, and before considering any potential investment decision, please consult with the properly licensed and registered legal and financial professionals. In just a minute, we'll talk about our summary for Progressive, but we have to address something first. What are the qualitative aspects of the business? So starting with some of the key points around a potential long thesis for the company, number one is that new concepts such as concierge claim service and snapshot discount will help the company manage costs while delivering a superior experience to policyholders. Number two, Progressive's focus on auto insurance leads to more stable results compared with other leading P&C insurers. And number three, Progressive has consistently outperformed peers in terms of underwriting margins. Then for some of the key points around a potential short thesis of the company, number one, technology will continue to play a large role in determining competitive dynamics in the auto insurance industry, and driverless cars could eliminate or at least dramatically reduce the need for insurance. Number two, State Farm, a mutual company, is the largest auto insurer. Mutual companies are not driven by the same profit motives as public companies and could undercut Progressive on price. And number three, Progressive operates in an industry that competes almost entirely on price. So insurance is a commodity industry. Hopefully that offered a balanced perspective around some of the qualitative aspects of both a long and a short thesis for the company. Now let's get to our summary. In summary, Progressive checks the box on 4 out of 6 of our metrics. They're earning high average returns on capital, although their returns on capital over their last 12 months are just about average. Over the last 5 years, they've grown their revenues and their free cash flows very strongly, but their earnings are down as they paid out more in policy benefits and they've had greater underwriting costs. Their shares outstanding are basically flat over this time, and we learned that the company is employing very moderate amounts of net debt relative to the cash flows that they're able to produce. On both an average and a current basis, Progressive is giving a free cash flow to enterprise value yield of greater than 7%, which potentially offers us that ideal risk premium we'd be looking for in comparison to the yield of the 10-year treasury. Then it looks like their very modest dividend yield is well supported by their abilities to produce free cash flows. And finally, performing a discounted cash flow analysis of Progressive. So if you've done the work and you believe those historical growth assumptions, then it looks like from today's valuations, you could reasonably expect about a 14% rate of return going forward from Progressive. So keep in mind there are a number of reasons why that potentially wouldn't be accurate. One of them is that Progressive has compounded at a rate of about 11% over the past nearly 2 decades. So that would mean that the company would be compounding at a rate even faster than this going forward. So that is a potential concern and a potential check to keep in mind. So it's worth reiterating that this type of analysis is not financial advice, it's not a buy or sell recommendation of any security, and before considering any potential investment decision, please consult with your financial advisor. This analysis instead serves as a beginning and holistic understanding of the Progressive Corporation to help you determine whether or not it's worth your time and energy to dig in and learn more about the business. One resource that will definitely help you stay up to speed with what's going on in the market and help you learn more about the business is Seeking Alpha. Checking out Seeking Alpha directly supports the channel as I'm part of their affiliate program. So most of you probably know Seeking Alpha as a source of community-written articles on different stocks. But over the past little while, they've actually become a lot more than that with their new offering, which is Seeking Alpha Premium. Premium has a number of different features where you can track buy, hold, and sell ratings on your favorite stocks. These ratings are from the Seeking Alpha community, Wall Street analysts, and Seeking Alpha's algorithm. You can see earnings call transcripts, investor presentations, SEC filings, and press releases all in one place. You can add your own margin of safety targets and get alerts for when your favorite stocks hit that level. You can get unlimited access to Seeking Alpha articles, and you can tailor your reading experience based on the type of investor you are. You can get 10 years of financial data on any stock to help you with your analysis. You can also import your portfolio into your Seeking Alpha dashboard to make researching easier. And if that didn't convince you, the best thing is that an annual plan is only $99. That's only 27 cents per day through my referral link down in the description below. Normally, premium is $239, but they are currently running a general offer for $119. But if you use my link, it's only $99. So check it out if you're interested. So as a value investor, you're ultimately trying to conduct your future research as if you're going to own 100% of a business, and you can truly understand the essence of that company and understand what's important and what's not important for that business going forward. So through this deeper research, you'll learn more about the qualitative and the quantitative aspects of Progressive, and you'll likely be able to determine for yourself what a reasonable and appropriate intrinsic value for the company will be. So with that said, that's it for today's fundamental stock analysis of the Progressive Corporation, ticker symbol PGR. So again, we were looking at Progressive today because it's the main competitor to Berkshire Hathaway's Geico, which has been one of, if not the best single investment for Warren Buffett over his entire career. Progressive and Geico typically compete neck and neck for adding new policyholders who have never had auto insurance before, and the results of their businesses have tended to be roughly similar over time. Today was also the first time we applied the Select 6 analysis to an insurance company, so I'd love to hear feedback about that in the comments below. So if you enjoyed today's video, please be sure to like the video, subscribe to the channel for more stock analysis videos, and comment down below what business you want me to take a look at next time, insurance or otherwise. Thanks for learning about Progressive with me, and have a great day.